Hey guys, welcome back to the Capital Mindset Show. So today we're going to be doing another update on Medical Properties Trust, ticker symbol MPW. So it's yielding about 10% here today. So if you don't remember, this is the video where I talk about actually buying it. We actually made a small profit, about 12-ish% around there. This is the video where I talk about selling it. And by then, the sell-off hasn't happened yet at this point in time. But in this live stream where I talk to everyone about what it is that I made changes on. You can see Capital Mindset portfolio update, Capital Mindset live, and then the time or whatever. I know, terrible titles, I know. But if you watch that, I kind of go over it. I'll give you the gist of it. It has to do with the management and some of the things that they were doing along with disclosures that kind of put me off with what it is they were doing. And so we sold the position for about a 12-ish% profit. And now, as of today, it has fallen drastically. So I'll actually pull up the stock price, and you can see now that it's at $11.86. So for a brief moment in time, we did see a rather decent rally up into August, and then that's a point where I exited the position, and now we're seeing that it's hitting all new lows at $11.86, yielding about 9.78%. So you're looking at that yield, and it's mouth-watering. So it's not without risk, definitely, and I'll kind of talk about some of the nuances regarding REITs like this. So MPW, if you recall to this video, a lot of the information still stands true, and that being kind of more focused on the different types of property types that we can kind of find in different REITs. It's a double-edged sword. I used that reference in this video, as well as the one in Vici Properties as well, kind of talking about the replaceability of each property and what happens if a tenant goes bankrupt. So that's the double-edged sword. And looking at MPW, one of the things that really put me off was the management team, some of the disclosures they were trying to avoid from filing and having to do with one of their tenants and credit facilities that they were giving out. And it kind of got even worse as they started to kind of create beef with an analyst, which if you guys don't know about that, I recommend you guys go check that out. But they started to create this drama, the management team, with an analyst, which was very unprofessional to say the least, because, so what if an analyst is having adverse opinions about your stock price? Let that happen. And if your business is good, don't worry about that. So, and then it kind of cascaded into some further questions about other credit facilities, and maybe there should be an investigation of sorts into these, and all that kind of just put me off from the business. But needless to say, though, this company is looking cheap, okay? I'm going to be holding off for now, but keeping an eye on it, kind of making sure and seeing, does that hold any truth to it? Or maybe should I kind of, give it a chance here? But for now, I'm kind of hands off here. And if I were to buy it now, I mean, we are historically speaking, but this is not a good barometer of success. Historically speaking, buying at these levels has been successful in the past. But that shouldn't be your measure of, okay, this is a good company to buy. That should not be that. Okay, going over to their balance sheet, we can kind of get a good taste of what this company's like. We can see, are they heavily leveraged? Are they using a lot of equity? What are they doing here? So we do see that the valuation of their land, and this is, of course, I think after the depreciation, its net of depreciation is at $13.696 billion, down from $14.062. Don't be too nervous about that. Again, depreciation is the thing. And then we do see investment in finance, REITs. Okay, real estate held for sale. So this is going to be at the fair value measure. And we do see that they don't have any designated for the sale as of this quarter. They've already sold some of that. So good to know there. And they have mortgage loan, a portfolio that has increased to about $314 million. So they do see gross investment in real estate has, again, come down. Remember, if that's coming from the land and also the real estate held for sale, so they got rid of that. And so when you add that together, it looks like it's coming down there. Okay, so they have cash and cash equivalents, decently capitalized for the size. A lot of these REITs are not going to have a ton of cash on hand just because a lot of the cash flows they do generate have to be paid out to shareholders. And the cash that they do have on hand is generally speaking for payment of liabilities or acquiring new properties, etc. So if we're looking at the liabilities portion of the balance sheet, we do see debt is about $10 billion. This already tells me right now that a lot of these properties are seemingly secured with a decent amount of debt, so a lot more debt leverage. And if you guys are from the Discord call on Sunday, a lot of the topics that we covered on today's call was around that leverage portion of REITs and what is pretty much the strategy of some REITs versus other REITs. And we went over some examples, but if you guys remember that, this is another example for you guys. So this one's a bit more debt focused than other types of REITs that we've seen. Now, if we're looking at some of the other parts of the portion, I want to take a look at the income statement. Let me see where I can find it. Revenues. There we go. So we have rent, straight line rent, income from financing leases, and interest from interest and other income. So I'm just trying to show you the breakdown of the different business lines that they do have. Of course, the vast majority is coming from rent, the traditional rent that we all think about. And we do see a nice increase from 2021 to 2022. Now, if you do recall, there is if you're going to be invested in this, and this is, I'm trying to be as objective and unbiased as possible and kind of taking a step back and being like a third party here. But if you are going to be invested in this company, I want to highlight one company that you do want to start paying attention to and kind of get a feel for it, because they are a publicly traded company, and that's Healthcare, or HCA Healthcare. They're a publicly traded hospital operator. And if you didn't know that this company was there, just jot it down and explore this company a little bit, get a feel for at least a little bit about this company. It's not saying that you should invest in it or anything like that. Just get to know that it exists here and then learn more about it, because also it could shed some light on other parts of the healthcare industry that you may not have known. But pay attention to this company in particular, because this is actually one of the larger tenants for Medical Properties Trust. And if you are not familiar with what kind of properties they do own, you can go to their website and you can go on their portfolio section and you can get a feel for what kind of properties they do own. Again, the part of where I told you guys the double-edged sword mentality or double-edged sword way of thinking regarding their portfolio, I think holds true even today. All right, all the information I said in that video holds true today. So it's good, but it's also bad. Like there's two sides to that sword there. And then you can kind of see their geographical breakdown through this map here, but they also have a chart down here, I think, and they have United States, international, so that you can show you how much they have here and how much they have international, but you can see what their focus is. And there's other companies within this space that I also might want to highlight too to you guys, but there's VTR. So VTR is Ventas, and this is a larger one. And I saw one of your comments here, and I don't remember who it was, but your comments in one of the videos stating that, well, a website was showing that Ventas was a higher quality than MPW. I'd be very cautious about some of these free websites. I'm not entirely sure how they measure the quality, but I will tell you that my personal opinion is that VTR is of higher quality than MPW. And not only do I think that, the market seems to be pricing that in as well. One thing that MPW kind of doesn't have that VTR does have is the management team, I think, is a little bit better at VTR, as well as the scale that VTR is currently at means that they're able to access swaths of capital that MPW simply isn't able to get at the present moment in time. Now, MPW has kind of survived a storm before. VTR has also survived the most recent storm as well. VTR's portfolio is drastically different, so you want to be a little bit careful with that. I'd say that if we're kind of aspects of VTR's portfolio is of lower quality. And a lot of times when we're analyzing REITs, that's a key point where we have to look at some of the qualitative aspects of the business. What's the makeup of their portfolio? What kinds of properties do they have? What's their geographic location, etc.? Because not all REITs are created equal, and different commercial properties have different grades. For example, when we're looking at, let's say, a mall or even an office building, we have different grades like A, B, and C, and that kind of drives the analysis forward, whether or not the REIT is a good REIT or a bad REIT, etc. So going over to the valuation tool, I kind of plugged it in already, and I need to actually indicate to the model that this is in fact a REIT, and so it can change up a little bit of how we kind of view this company. But if I go over to some of the what some of the industry is saying, they're saying, well, strong buy, hold, overweight, buy, strong buy, neutral, hold, overweight, hold, and neutral. Now, some of the estimations on growth are kind of, I think, reserved. So I've seen some analysts kind of estimate that the growth is going to be in those single digits, mid single digits, low single digits going forward. And I'd really say that it really does depend. One thing that kind of culminates into some of the struggles that REITs are going to go going forward. If you recall this video here, so this is when the channel was much smaller, but this video only got 458 views. In this video, I do talk about some of the struggles that REITs might face in this year, 2022, with the liquidity crunch. It is something that the channel has been kind of almost not, at least the subscribers of Capital Mindset have known for me to say the word liquidity crunch. Actually, that was a huge topic of today's call as well. But going over REITs as a whole during a rising rate environment when capital raising capital becomes ever more expensive, it becomes harder and harder for them to grow. And something like MPW, which its stock price is falling drastically and rates are also rising simultaneously, this makes it harder and harder and harder for the company to make accretive deals because their cost of capital is going to be simultaneously rising. And so you're going to see a slowdown in that growth. And that's unfortunate for, current holders of MPW, but you are going to see a slowdown in that growth. And that was another kind of key aspect. Well, when I was initially adding to the MPW was under that understanding that we're going to be in a turbulent time. So it wasn't going to be a bit large size. But again, that management question marks really got me out of the stock. And so, for better or for worse, it's good. Okay. And then going over some of these other REITs, because I'm going to make some other videos on other REITs, because it seems like a lot of the high quality REITs, if you recall, I've made all these other videos over time this year on, how for now I was not correct, but now it seems that a lot of the REITs, and again, this will be discussed in the upcoming videos on REITs, these high quality ones, they were seemingly resistant from the liquidity crunch. And it seems like they were stubbornly not coming down, but now all of a sudden they kind of all just dropped. And I'm talking about the highest quality ones because some of the ones that were not, still high quality, like Prologis, really kind of followed the trend line that we would expect. Granite Properties in Canada also follow that trend line. A couple other industrial property or REITs followed that trend line. So those kind of participated and made me look good, but some of the ones like Realty Income Delaware did not make me look good, or WP Carey until kind of now. But anyways, kind of going over MPW and finalizing my thoughts here on the evaluation tool, what you would probably need is kind of this understanding that the cost of capital is going to be rising significantly. And with that being said, you probably are going to desire a greater and greater and greater discount on the future cash flows because you're going to be having a lot of uncertainty. I'd say the growth rate is going to be probably around that 4% mark. So, funnily enough, if you're, that's kind of what you're looking at, there you go. But if you're kind of thinking that cost of capital is going to be a huge problem and we don't really know where rates are going to be rising for real, we could expect a little bit more downside here, or this whole management fiasco is a huge problem, and in which case you have something else, a wholly different problem on the horizon in the form of, some action being taken against management for what they've done. Okay, and that's if something has happened. Now, if you might notice, you might be looking at this company and you might notice the book value is about $15-ish, and it's currently trading for $11.86. And you might be thinking that's very cheap. Well, indeed, that is very cheap. So the market is giving you either an opportunity or it's telling you that there's something severely wrong, okay? And that's for you to determine when you come to a conclusion. What I recommend everyone do after watching this video, if you want further context, I recommend you look up MPW stock or medical properties. Maybe you type in the full name, Medical Properties Trust Stock Analyst Fight. And then you kind of get, there are some videos because there have been some interviews with the analyst in particular and talking about, okay, well, what was going on, the management fought. So kind of get an idea of the full context of what was happening. And that analyst does go into some of the issues that went on. So I did see that interview after the fact. And I thought, that guy covered it pretty well as far as like what the analyst said. Watch the interview if you so choose, and that should color the picture a little bit better for you. But again, it does look cheap, undoubtedly. High dividend yield. Who doesn't love a high dividend yield? One other thing I'll say is that for the American investors and maybe the Canadian investors as well, REITs are the most beneficial when we have them in tax advantage accounts because they don't get taxed on the corporate level. They are pass-through entities, which means all the taxes flow to the individual. And if we hold it in tax advantage accounts, then we aren't taxed on the individual basis. So therefore, there's no taxation at any point in time as far as the corporation goes and its distribution goes. Okay, so that being said, thank you guys so much for watching, and I will see you guys on the next one. Bye.